The S&P 500 just tagged 7,000, and it feels like the party on Main Street will never end. But while retail investors are popping the champagne, the pros are staring at one specific chart in absolute terror. And it's not the one you think. It's the VIX, the market's fear index, and it's flashing signs of a potential bull trap, the biggest we've seen in a decade. So, what's the real story? In this video, I'm breaking down the critical disconnect between the record highs and the fear bubbling just beneath the surface, and I'll show you exactly how to play it. It finally happened. In early 2026, the S&P 500 briefly touched 7,000 for the first time in history. It didn't close there, but that number was a massive psychological milestone. The headlines were electric, and all over social media, investors were posting portfolio screenshots, celebrating what felt like an unstoppable winning streak. And it wasn't just the S&P. After a monster 1,200-point rally, the Dow Jones Industrial Average finally closed above the 50,000 mark. It seemed like every corner of the market was on fire. On the surface, the reasons look solid. The US economy, despite a few weak spots, appears to be on a strong foundation, and GDP growth forecasts for 2026 have even been revised upwards. For over a year, corporate earnings have been on a roll, posting 5 straight quarters of double-digit growth. Companies are pouring cash into the future, with huge investments in AI, software, and the data centers powering our new economy. And the cherry on top? The Federal Reserve has taken its foot off the brake, holding interest rates steady. You put all that together, and you get a story that's almost impossible not to believe in. Strong economy, booming profits, a friendly Fed. The narrative on the street was simple. This market is a one-way bet. The only mistake you could make was staying in cash. But this is where the story takes a very sharp turn. So that's the picture everyone sees. Now, let's look at what has the smart money on edge. To do that, we need to talk about the VIX. You've probably heard it called the fear gauge. When the VIX is low, investors are calm. When it's high, fear is spreading. Logically, with the market hitting all-time highs, you'd expect the VIX to be asleep, right? Wrong. In January, as the S&P 500 marched toward its record, the VIX didn't stay quiet. It suddenly spiked, jumping over 20 on geopolitical news before settling down. It's been showing that fear is creeping back in. The market has shrugged it off for now, but these sharp spikes in volatility are a huge warning sign. They show a market that's jittery underneath a confident facade. This combination, record highs met with sudden jolts of fear, is the textbook definition of a bull trap. A bull trap is a false signal where a surging market tricks optimistic buyers into piling in right at the peak, just before it reverses and traps them in losing positions. It feeds on the fear of missing out. We've seen this pattern before at major market tops. There's a feeling of invincibility, a belief that this time is different, while warning signs get brushed off as noise. The fear today is that retail investors, cheered on by happy headlines, are the ones walking into this trap, while seasoned pros see the rising volatility and start taking precautions. But here's where the story gets another layer deeper, and it's something most of the bears are missing. What if this isn't a trap for the bulls? What if it's a trap for everyone who's been sitting on the sidelines, paralyzed by fear? To understand this, we have to ask a critical question. What's actually driving this rally? Is it just a handful of mega-cap tech stocks? Or is the whole army marching? This is called market breadth. And right now, it's telling a powerful story. For a long time, the rally was incredibly narrow. It was all about the Magnificent Seven. But the data from early 2026 shows a dramatic shift. For example, while the S&P 500 posted a modest gain in January, the real action was under the surface. The energy and materials sectors have been surging. We're also seeing new strength in industrials, healthcare, and even real estate. This is what analysts call rotation. Money is flowing out of the overloved tech giants and into other parts of the economy that do well when growth is real. Even more telling is the performance of small cap stocks. The Russell 2000 index has been outpacing its large cap peers, a classic sign of a healthy, broadening rally. It suggests the economic strength is widespread, not just speculative froth in a few AI names. with over 68% of stocks in the S&P 500 now trading above their key moving averages. The vast majority of companies are in a healthy uptrend. This doesn't look like a fragile market. It looks like a market with deep, underlying strength. So, what does this all mean for your money? We've got record highs, a nervous VIX, but also solid fundamentals and broadening leadership. This isn't a simple sell everything or buy everything moment. It's a signal to be smart, not scared. Here are 4 strategies to navigate this. First, embrace the rotation. The biggest mistake you can make right now is being over-concentrated in last year's winners. The market is telling you leadership is changing. Consider using low-cost ETFs to get exposure to these new leaders like energy, materials, and industrials. Second, use strict risk management. Watch the 6,700 to 6,800 zone on the S&P 500. A decisive break below it could signal a bigger pullback is coming. Set personal rules for your portfolio. Maybe it's a trailing stop loss of 8% on your stocks. Or maybe you never risk more than 2% of your portfolio on a single idea. Third, learn to use fear as your friend. Instead of panicking when the VIX spikes, see it as a signal. These moments of high fear are often when the best buying opportunities appear. When the VIX jumps above 20, it can be a green light to start buying quality companies at a discount. Panic provides liquidity for the patient. Fourth and finally, keep some cash ready. Having dry powder on the sidelines isn't a sign of fear, it's a tool of opportunity. Analysts note there are imbalances in the market that a pullback could resolve. Keeping 10% of your portfolio in cash allows you to take advantage of those inevitable dips. So, is the S&P 500 at 7,000 a top or a trap? The evidence suggests it is a trap, but most likely for the bears who have been sidelined, waiting for a crash that hasn't come. While the headlines and the jittery VIX paint a picture of a fragile peak, the underlying data shows a much healthier reality. The rally is broadening, leadership is rotating, and corporate profits are solid. This doesn't mean we're going straight up. Volatility is rising, and pullbacks are not only possible, but healthy. Key support levels around 6,800 will likely be tested. But the biggest risk right now may not be getting caught in a crash, but getting left behind by a fundamentally strong market. So, I want to hear from you. Are you positioning for a pullback, or are you riding the rotation into these new leading sectors? Let me know your strategy in the comments below. And if you got value from this breakdown, make sure you subscribe and hit that notification bell. Thanks for watching.